Michael Chiu, Senior Investment Manager at ING Investment Management, which manages about $86 billion in assets across the Asia Pacific. Good morning to you, Michael. So what about these CPI numbers? How much do you take into account the fact that we had Lunar New Year in January this year?
Yeah, I think there will be some short-term impact due to the Chinese New Year effect. But over the next 6 months, we still expect the CPI inflation number will continue to come down, partly because of the higher base effect of last year in 2001, and partly also because recently we are seeing food prices are really coming down.
Yeah, is it the time to buy into Chinese shares? I mean, here in Hong Kong, we've seen the Hang Seng Index really fly since the depths in October. We're up 30% since then. Is it too late to get in?
Well, put it this way, I think very short term, the market has gone up a lot, so I won't be surprised if there will be some short-term consolidation. But at the end of the day, if we look at the valuations, now the MSCI China is trading at 1.5 times price to book versus the trough of 1.1 times in 2008 and the peak of 2.5 times in 2009. So I still expect some reasonable upside if investors get in now.
Yeah, what's the reasonable upside? Are we still looking at double digits from here?
Well, hopefully, I think the earnings in China should be supportive of the kind of 15% growth in China, and consider that we have a very bad year in 2011. So maybe right now we are playing some catch-up, and later on, I hope the market index will be following the earnings growth in China. Right. That would give investors some decent return.
Okay, let's take a look at your allocation for your Greater China Fund. This is interesting because 47% of it is in China. Does that mean in Shanghai or here in Hong Kong with the H shares?
Most of them will be in Hong Kong, the H shares and the red chips.
Okay, and then you have Taiwan has 25% of your portfolio.
That's right.
Some would say that Taiwan has kind of been disappointing so far.
Well, in fact, if you look at the real numbers in the last 4 years, actually MSCI Taiwan has outperformed China for the 3 out of the last 4 years.
Okay.
So in fact, the market performance of Taiwan was not so bad. And on top of that, if you're looking at on the political front, the election results, I think the market welcomed that, and hopefully there will be some continuity of the policies on the Taiwan side. Okay. So this is one of the reasons why we continue to like Taiwan.
All right, and taking a look at the sector allocation financials, the absolute overweight here, 30% of your holdings are in banks. Are these Chinese banks? Are these Taiwanese banks? Are these Hong Kong banks?
A bit of both, but more skewed to the China side, of course. And more importantly, I think we held contrarian views a couple of months back when I met you last time, that people were worried about the China banks, but we were saying that actually the market may be overly concerned about the credit quality, the capital adequacy ratio, and so on. And that was why we have been increasing our China bank exposure, and we have been profiting from that.
In IT, this is interesting.
Yes.
When you say IT, what does that mean? Are we talking about handset makers? Are we talking about Lenovo PC makers? Are we talking about chip manufacturers? What are you specifically looking at? Well,
traditionally, that would mean the Taiwan technology companies that are tailored to the export demand from the developed world. For example, the smartphone-related food chain, they are doing quite well last year. But more importantly, we are also seeing the domestic demand here in China. For example, the 3G plans in China, they also want to build a capex, and they also want to integrate different networks in China. That will create some technology demand in China as well, domestically.
Okay, Michael, good to see you. Enjoy the rest of your week. Michael Chiu of ING Investment Management.